A car repair, medical bill, or sudden job problem can turn a normal week into credit card debt when there is no cash waiting for the unexpected. The emergency is painful, but the bigger financial danger is being forced to borrow at the worst possible moment. An emergency fund is not lazy money. It is a financial shock absorber that keeps one bad event from damaging the rest of your plan. An emergency fund is cash reserved for urgent, necessary, and unexpected expenses. It is not an investment account, and it is not a general spending fund. A true emergency is urgent and necessary. A one is optional. An expected expense may be inconvenient, but it belongs in a sinking fund, not the emergency fund. Common emergencies include income loss, a medical cost, a major car repair needed for work, or a critical home repair that cannot safely wait. Not every unplanned expense qualifies, and the difference matters. A vacation, holiday gifts, a new phone, or a sale purchase may be important to you, but they are not emergencies because they are optional or predictable. Tires wear out. Insurance renews. Holidays return. School costs arrive. Build separate savings for those items so they do not repeatedly attack your emergency fund. Emergency money has one main job: be available when life does not follow your schedule. Investments can fall exactly when you need money. A savings account may earn less, but the cash remains stable and accessible. The emergency arrives, cash is available, the bill is paid, and your long-term plan survives without a new debt balance. Watch what happens to the exact same bill when there is no cash waiting. Without cash, the same emergency may move to a credit card, create interest charges, and reduce future cash flow for months or years. It gives you time to make a better decision, compare options, search for work, or recover without accepting the first expensive solution. Do not wait until you can save 6 months of expenses. Begin with a starter amount that can handle the most common small emergencies in your life. For many households, $1,000 is a practical first target. $2,000 is stronger. 1 month of essential expenses creates a much better cushion. Build in stages. First $500, then $1,000. Next 1 month of essential expenses, and later 3 to 6 months. Use automatic transfers, part of a tax refund, a bonus, or money from selling and used items to reach the starter target faster. A $1,000 fund may not solve every crisis, but it can stop many ordinary problems from becoming high-interest debt. Your full lifestyle cost is not the number you need. Start with the expenses required to keep the household safe and functioning. Include housing, basic utilities, essential groceries, insurance, necessary transportation, minimum debt payments, and critical medical costs. A household may normally spend $5,000 per month, while essential expenses are only $3,500. The emergency target should begin with the essential number. If essential expenses are $3,500, 1 month is $3,500, 3 months is $10,500, and 6 months is $21,000. The correct target depends on the stability of your income, the number of earners, your insurance, your health needs, and how quickly you could replace your job. A stable 2-income household may feel comfortable near 3 months. A single income or variable income household may need closer to 6 months or more. Freelancers, commission workers, business owners, and people in highly specialized jobs often need a larger fund because income can take longer to replace. Your household situation matters just as much as how you earn. Ongoing medical needs, an older home, an unreliable vehicle, or family members who depend on you can also justify a larger cushion. 3 to 6 months is a framework. Your real life decides where you land inside or beyond that range. The best emergency fund location is usually a separate insured savings account that earns interest and can transfer to checking quickly. Look for 4 qualities: safe, liquid, separate from daily spending, and boring enough that you are not tempted to trade or chase returns. A high-yield savings account can be a good home when it has deposit insurance, no unnecessary fees, and a reliable transfer process. Keeping everything in checking makes accidental spending easier. Locking it in volatile investments creates the risk that the money is down when you need it. Keep the fund reachable, but you do not need to stare at it every time you open your daily banking app. Before withdrawing, ask 3 questions. Is it unexpected? Is it necessary? Is it urgent? If the answer is yes to all 3, The emergency fund is probably doing exactly what it was built to do. An emergency room bill, a broken furnace during dangerous weather, or a car repair required to reach work usually passes the test. Some expenses feel urgent in the moment, but do not actually pass. An annual insurance bill, planned travel, or routine maintenance usually fails the unexpected test and should come from a sinking fund. Using the fund is not failure. The fund succeeded when it prevented debt. Your next job is to rebuild it. After a withdrawal, temporarily reduce optional goals, rebuild the emergency fund, and then resume the rest of your plan. You bought the shield so it could absorb a hit. Refill it with discipline, not shame. A strong stock market can make cash feel wasteful, but emergency money is not measured by maximum return. It is measured by reliability. After a reasonable starter fund, extremely high-interest debt may deserve priority before you complete the full 6-month target. Keep basic protection, then attack the expensive debt that is draining cash flow. Afterward, finish the larger emergency fund. Mixing emergencies, vacations, taxes, and home projects in one savings balance makes it difficult to know what is truly protected. Separate emergency money from predictable expenses and personal goals, even when all three accounts are held at the same bank. Calculate 1 month of essential expenses, choose your first milestone, and schedule an automatic transfer for the day after every paycheck. Write the target, open or rename the savings account, automate the transfer, and track the percentage completed each month. Investing helps money grow. An emergency fund keeps you from being forced to sell investments or borrow when life goes wrong. In the comments, share your first emergency fund milestone. 500, 1,000, 1 month, or another number that fits your household. Build the starter fund. Grow it toward 3 to 6 months of essential expenses. Keep it safe and use it only for urgent, necessary surprises. Subscribe for more Money Map. Up next, we calculate net worth and why a big salary doesn't guarantee real financial strength.